Welcome back, everyone, to Millionaire Mentality, where I teach you to grow your financial IQ, build your wealth, and take control of your life. Mike Tyson once famously said, everyone has a plan until they get punched in the mouth. Well, when it comes to investing, everyone seems to have a plan until they start to lose a lot of money. In today's video, I'll be discussing everything you should and should not be doing with your investments when stocks or crypto are crashing in price. Before we go any further, don't forget to subscribe to the channel and throw this video a like.
Do it. Do it.
Now let's get into it. A solid investing plan is one that works whether prices of an asset are climbing or falling. If you don't have a plan, it's much easier to panic when the assets you own are in decline. A good investing plan should include which baskets of assets you wish to invest in, such as certain index funds or even crypto, and the percentage you wish to allocate to each of those assets based on your risk tolerance. And you learn a lot about your risk tolerance when you are in a down market and are losing a lot of money. Risk tolerance is personal, but your age can have a lot to do with it. Someone who is younger and many years away from retirement may have a stronger appetite for risk and volatility in return for more growth in the value of their portfolio, versus someone who just recently retired and is more concerned with price stability and the preservation of their wealth. And once you determine what you're investing in and how much you want to allocate to each asset, it's important to stay the course with your plan. As scary as market crashes may be, they offer tremendous opportunities for younger investors who are able to control their emotions and stick with a sound, long-term investing plan. Let's talk some terminology now. A correction in the stock market is defined as a decline of 10% or more in an asset class. A bear market, on the other hand, is defined as when an index, such as the Nasdaq 100, is in decline of 20% or more. Speaking of the Nasdaq 100, which is an index of 100 of the largest non-financial companies, is down 28% year to date, which officially places it deep in bear territory. The S&P 500, which is an index of the 500 largest US stocks, is almost down 19% year to date, officially putting it into correction territory, but teetering on the verge of a bear market. And the Dow Jones Industrial Average, which is an index of 30 prominent US companies, also known as blue chip stocks, is holding up the best, but still down almost 15% year to date. So to say things another way, the stock market is in the toilet right now, and it's not just stocks. Bitcoin is down over 50% from its record high in November 2021. So what in tarnation is going on here? Well, it's complicated. And there's not just one reason stocks and crypto are in a free fall. The main driver of panic and fear right now is the lack of faith in the Federal Reserve to use their tools to bring inflation levels back down to a healthy level of 2 to 3% without causing disruption to the economy. The latest Consumer Price Index, or CPI reading, which is widely used as a measure of inflation, was reported at 8.3% for the month of April, which is a level not seen in the US for about 40 years. To make things even more complicated, investors are now weighing the risk of a possible recession within the next year. And when you have slowed economic growth as seen during a recession, on top of high levels of inflation, you are left with something called stagflation, which is unusual because historically, high levels of inflation are accompanied by soaring economic growth. The Federal Reserve printed too much money too quickly, and they got caught with their hand in the cookie jar. And with that, the former SEC chief economist sees the odds of a recession are likely in order to fight this inflation. But wait, there's more. There's a war in Ukraine striking geopolitical fear, major government spending and aid, and rising gas prices. A once-in-a-century global pandemic that continues to rage on, with spikes in COVID-19 cases being reported throughout the month of May. And because we are no longer living in real life, and this is all just a simulation, we now have fears of monkeypox spreading across the globe. So does this mean you should sell all your stocks and become a doomsday prepper? Well, that does sound kind of fun, but probably not what's in your best interest. These are certainly challenging times for so many different reasons, but the US economy is resilient, and it's not the first major crisis or market crash it's experienced, and I can guarantee you it will not be the last. A closer look at how the S&P 500 index has performed over the past century illustrates just this. The US markets have had a lot thrown at it. From the Great Depression of the late 1920s and early 1930s, the attacks on Pearl Harbor preceding the US involvement in World War II in the 1940s, the Black Monday stock market crash of 1987, the dot-com internet bubble crash of the early 2000s, the Great Financial Crisis of 2008, and now, most recently, the outbreak of the pandemic and global inflation fears. These all cause short-term pain and decline, but when you zoom out and look at the trajectory of market performance, the market marches upwards and crises end, and US companies adapt to market conditions to continue to innovate and grow. So just what are those tools the Federal Reserve has in order to fight the inflation they caused by printing 80% of all dollars in circulation over the last 2 years alone? They need to continue to raise interest rates higher and higher, which is what creates the high likelihood of a recession. Short-term pain from a recession is the necessary short-term evil to avoid sustained long-term evil of high inflation. Recessions are fairly common, and prior to the onset of the pandemic in 2020, there have been a total of 13 of them since the Great Depression. Now, none of us have a crystal ball, and so we have no idea when this market crash will bottom, or if today was the bottom. Just like we had no idea when the peak was going to be before this crash even started. And if you're waiting on the sidelines with cash, trying to time the bottom, you're not going to buy back in until you see the markets starting to dramatically rise again. But by then, you may have missed out on having money invested during some of the best trading days of the past decade. To illustrate this, had you invested $10,000 into an S&P 500 index in 2000 and kept it invested until 2019, your investment would have grown to a little over $32,000. But had you tried to time the market and buy and sell instead, and maybe missed just the 10 best market days over those 19 years, that $32,000 would be cut in half and worth only $16,000. And it gets much worse the more of those big green days in the market you miss out on. Stick to your asset allocation based on your risk tolerance, then just keep buying. And in the words of Jack Bogle, the legendary founder of Vanguard,
switching involves timing. Should I do it today? Should I do it tomorrow? Should I wait for a year? And those decisions are just going to be flawed. You're going to be moved by your own emotions, maybe the emotions of the advisor that you have, who really knows. But there's no evidence at all that trading back and forth enhances returns, and all the evidence in the world is staying the course, for the want of a better word, is the course that will give you the optimum returns.
That's going to do it for this video. I am still running a promotion where if you subscribe to my channel, comment on this video to let me know, and send me an email. My contact info in the description below. I'll reply back with a free copy of my short ebook, Financial Health. These 6 simple steps to stop fearing money, grow your wealth, reduce your stress, and take control of your life. Stay hungry, and I'll catch you guys in the next video.